All right, welcome everybody to the Wide Lens podcast, episode number 16. I'm Robert Baharian, and I have are you a co-host? My colleague, co-host.
I've been promoted, have I? Co-host, look out. I'm moving up in the world, people.
Well, we gotta become professional at some stage, at some point. Matt Rigby, we are recording this on Friday, the 13th of May, 2022.
Scary.
I don't know what
Look out,
spooky
Marcus.
stuff's going to happen tonight.
It's been happening all year.
I don't think anyone's going to be afraid. We've seen it already. We've got a ton of stuff to cover today. Actually, there's been a lot going on, but we'll kick off with Matt's market minute, and let's get straight into it, Matt.
Alrighty, so Aussie market last 5 days down just under 6%, down 8.8 for the year to date now. So it's starting to accumulate those losses. Look, some interesting earnings, some disappointing earnings coming out. Xero came out. They're down about 14.25 for the week to last night's close. Sorry. They're still investing in the product, not focusing on growth, on profits. So that was, I think, what the market was disappointed about. CSR came out. They were down 12%. Link down about 18%, and Dicker Data down about 3%. They all disappointed. On the positive side, CBA down about 0.5%, but they look like they've basically locked in 3/4 of decent profits. Look like they'll meet, if not exceed, expectation. So that's good. Lifestyle Communities, something I think nobody talks about. That's up about 3% on their trading update. Pendle down slightly, but they had a good trading update. Westpac, strong cost control. They're down a little bit, probably more reflective of the market generally. And Suncorp down. They're up about 2.5 for the week. Again, coming out with pretty good numbers there. The Nasdaq last 5 days down 6.5%, now down 27% year to date. Refinitiv is now working again, sort of. 82 stocks down more than 10% for the year to date. So 82% of the Nasdaq 100 down more than 10%, 13 in positive territory.
13% of stocks are only in positive territory for year to date.
Yes. Yep. Yeah, on the Nasdaq.
Apple, Microsoft, Google.
No, I don't know that any of those. I'll have to have a look. I'm not sure. I didn't take any notice. S&P 500 down just under 5% for the week. Now down 18% year to date. So nearing that 20%. Psychological,
bear market,
whatever that is.
Technically, it's not a bear market, Matthew.
No, we're not there yet. Year to date, 109 or 25% are positive, 309 or 61% down more than 10%. It's nasty.
Stock picker's market, isn't it?
It really is. Pick cash. And earnings. So this is all based on Yahoo's reporting. So a couple of companies that beat during the week. EA Sports up 1.5%. The Trade Desk, which is a company I really like. I think it's got great prospects. They beat and are still down 17% on expectations of slightly lower growth. But interestingly for them, they make a lot of money off selling ads. With Netflix and Disney all going to ad-supported models,
right.
I think that's going to be a real big tailwind for these guys.
Roll the dice.
Why not? Companies that missed: Disney down 6%, Roblox, probably the best metaverse play at the moment, I would say. Anyway, down 7%. Beyond Meat down 34%. Yeah, a bit nasty.
No more vegans in the world.
Zynga missed. Rivian, the Tesla rival, I don't know if you can call it that, down 21%. Not great earnings, but also Ford and Amazon are out of their lock-up stage, so they can start selling those shares. And Under Armour.
Great time.
Yeah, Under Armour down about 7%. Emerging markets, as gauged by the VGE, Vanguard Emerging Market Index Fund, down 2.6% and 15% year to date. So that's actually better than both the Nasdaq and S&P. That's interesting.
Well, I think like with emerging markets, you don't have like the FANG style, the growth heavy stocks. I think like a lot more, be probably more value orientated. So I think relatively speaking, you're probably going to get a slightly better performance than if you compare that to a Nasdaq, I reckon.
I've never thought about that. Yeah, I don't know. That's interesting. We'll put that on the future research list. Oil down about 2.8 for the week. up 41% year to date, now trading at 106 or thereabouts. Bitcoin, it's getting nasty. So
are we moving on to the next topic? What are we at?
Well, I'm just going through the
Okay.
stuff. So Bitcoin's down 19% year to date, for the week, 19 for the week, 39, let's call it 40% year to date. Now trading at 28,739. They got as low as 26,284 yesterday. And I was watching it yesterday. They were down 14% at one point yesterday, came back pretty hard, and they're off again today. So we'll touch on cryptos later, but it's people are starting to feel the pain, I think, in that space.
Yeah, well, when I unsubscribe from the 3 daily emails that I get from Coinbase to tell me that your Bitcoin is down 7% in the last 4 hours.
Yeah,
I'm like, okay, if you can't stomach this, you shouldn't be in it.
Don't need to know it.
Unsubscribe, just let it do what it does.
Yeah, well, someone was saying, made the comment, where are all these crypto experts and pro-crypto people that I was hearing about, hearing from 6-12 months ago? They're all disappearing. And that's kind of a good sign that things are starting to capitulate. And once that happens, maybe it's at a buy point.
Get rid of Deadwood, hey?
15,000 was my prediction in January.
Mate, and pretty closer to yours.
Well, we're getting closer than we were a few weeks ago. Who knows? I think it'll go under 20. I don't know how far.
Do you buy it under 20? Well, you're not really into...
I possibly would.
Mate, just dabble. Well,
throw $5 at it, maybe. I don't know.
Australia just had the first crypto ETF launch yesterday.
Yeah.
What a day to be launching a crypto ETF. Like, talk about creating products at the worst time.
Yeah.
But I don't know how much they brought in, but they put in quite a bit of money.
Yeah. And I don't think it's a straightforward. It's not an index ETF. I mean, it's a whole lot more complicated under the hood.
100%.
I think there's a lot of leverage there, and so maybe we need to have a look at that and inform the people. But it's tread carefully.
All right, well, let's add that. Let's have a look at that next week, actually.
Yeah, for sure. All right. So earnings season. So despite all the doom and gloom that I just mentioned, it's been a reasonably good reporting season so far. So we'll bring up this first graph, which is the percentage of companies beating...
You're still using the word graph.
Oh, chart. Bring up this first chart, and it's the percentage of companies that have already reported who have beaten on earnings per share, on the earnings per share number, and on the revenue estimates as well. So the dark blue line is the earnings per share beat. The lighter blue is the revenue beat. And you can see that, historically, those numbers are really high. So 74% are beating on earnings per share. Oh, wow,
this goes back to 2001.
72% on revenue. Yeah, I mean, it's only, there's only been a couple of occasions where those numbers have been eclipsed, which I found really fascinating. And when you go back to historical, there's no average, but just eyeballing it, 55%, 60% of companies typically will beat? If I'm using that as the average,
is there an upward trend here, above. Meaning over time, analysts are getting it wrong, and companies are more and more beating?
Yeah, maybe.
Because there's a clear uptrend there, right? I mean, notwithstanding those significant dips during GFC and 2012 and
so
COVID.
On. But yeah, there is an upward trend, and is it the margin? Is it more tech companies are reporting or listed and reporting, and they've got higher margins, and therefore that's not factored in? I don't know. It's one of the two, but that's an interesting point.
But the absolute numbers are pretty solid. More than 3/4 of companies are beating on earnings and revenue.
Yeah, absolutely. So that's really good, but often it's the guidance. So, which is the next chart that we'll bring up now. So the percentage of companies raising or cutting their guidance by quarter. So less than 10% of names are actually increasing their guidance. So you can see there that the dark blue line is the raise, and the light blue is the cut. So it's a big drop though. It's a massive drop, and I think that's the issue that we're dealing with at the moment. I think investors have gotten used to, a beat and a raise, beat on earnings and raise again. And that's obviously not happening, but it's still not at historically low levels, which was interesting. But the cuts are pretty healthy level.
They look pretty stable to me, but you cannot. I mean, what else are companies going to do, right? They can't. We're in this situation whereby, remember we were in 2020 and the company was just giving no guidance whatsoever.
Yep.
And I think that's fair. I mean, what are companies supposed to say to investors and shareholders right now?
Yeah, well, I think it was Starbucks pulled guidance, so they didn't provide any guidance and got hit. And, they've got a fairly big presence in China and all the lockdowns. So that's fair enough. And I think,
I think
2020 was
one or
pretty fair
two
enough.
out of three of their stores are shut in China.
Yeah, it's a pretty high number.
How can you provide guidance when you're basically shut down?
Yeah, no chance. And that's the conclusion they came to. But, I think also from a management team's perspective, you've got a choice. You can be aggressive or you can be conservative when you're announcing earnings and talking about the next quarter. And we're partway through or halfway through that next quarter already. So they've got a pretty good idea of what's coming. There have been a number of companies also talking about their hiring and not basically pulling back on hiring, basically saying, we're not going out there. Hiring is a privilege. It's getting too expensive. And so it's early and there's a couple of big companies. Uber's one that springs to mind. I imagine Amazon probably will be, given they're overcapitalized, so to speak. That's a trend to watch. As labour becomes more expensive, it becomes less attractive and less profitable to put new people on. So,
but even already, I don't know if it was Coinbase, but the likes of Robinhood, for example.
Robinhood, that was another one.
Yeah, I think they cut like 9,000 jobs or something like that. So I think those really high growth companies that just grew spectacularly well during COVID, I think they're the first ones that are cutting.
Yep.
And I don't disagree with that. I think we'll see like this trickle down effect to less volatile, less high growth companies who've also been hiring like crazy over the past couple of years.
And small, your mum and pop stores, they're all out there hiring as well. And they are the biggest employer segment in the US.
Well, if rates are going
Australia
up and they've got a higher costs and with inflation, I agree. I think they're going to be like companies not providing any guidance. They're the ones going to say, well, we're not hiring and we're just going to turn that tap off for the moment.
Absolutely. I'll just work an extra few hours, as the owner. And at a sector level, just really quickly, pretty interesting that, some of the areas or some of the sectors that have done quite well. So revenue beat rates were strongest amongst materials, strong-ish amongst industrials.
So what's this chart showing? What's the blue and red mean?
So the blue is kind of the stronger end of the scale.
Oh, gotcha.
The red or orange is the weaker end of the scale. So you've got earnings per share in that first block, revenue and guidance. And guidance is probably really the one to look at. That's what's driving everything. And probably not surprisingly, technology is one of the it's actually the lowest on guidance.
So is that saying really 30% of tech companies have provided no guidance?
Yeah, basically. So, that's creating that uncertainty. A good chunk in line, some cutting, but, I think there's probably more and more of a trend towards just not providing guidance. So plenty of businesses are doing really well. Revenue and profits are growing strongly, but I think that uncertainty is really starting to come through.
Let's talk about the bloodbath in stocks, and we've got to cover a lot of this later on. But the first chart that I want to bring up is from Deutsche Bank, from Jim Reed, and what it's showing is the number of consecutive, and this chart's up now, the number of consecutive weekly declines for the S&P 500 of more than 5 weeks, and Jim goes on and says we've just ended the longest run without one. You can see from that chart, it's not that obvious, but we haven't had a period of negative weekly returns for 5 weeks since 2011.
Yeah.
And so we've gone 10 plus years without a negative streak as we've seen now.
Yep.
In fact, some of the numbers, so June 2011 actually was the date. Now ends the longest. So they go on to say, as the graph shows, this now ends the longest run without such an event since weekly data begins in 1928. In the 83 years between 1928 and 2001, we had 61 runs of 5 or more weekly declines in a row. So one every year and a third on average, even if a number of them were concentrated together. So I think the conclusion here is what we've seen over the course of the last 10 years is not the norm.
Mm-hmm.
And that what we are seeing now is probably more akin to what markets should be doing. You and I have talked about this where, I think it was a few weeks ago, we were chatting about the 2001 max drawdown in the S&P 500. It was like 5%.
Yeah,
and people were just totally oblivious to that fact. And the point we were trying to make was that is not normal.
Yeah.
That in fact, what we're going through now with an average, in fact, S&P 500, the average drawdown is 15% or 14 point something percent.
Yeah. So we're at
per
18
annum.
now, I think it was.
At an index level.
Yeah.
And so what we're seeing now is a lot more normal. I think this was really interesting. It looks like these things cluster together as well quite a bit. So the fact that we haven't had one for a little while and we've got one now, maybe we're just going to start to see a lot more volatility going forward.
Yeah. Well, this week's going to be negative, so that'll get us to 6. What's interesting here is there's only 3 instances where it's gone above 6 weeks. What's that? No,
oh, yeah.
Late 60s.
2000.
Like early 80s, maybe in 2000. So just one positive week would be nice at the moment. just come on.
Let's have a look. Let's keep going with this theme because it's going to be common in all the topics that we talk about today. Let's talk about inflation. Let's talk about rates. So the US will bring this chart up from Statista, which is showing the Fed cash rate. It's that blue line. You can see the 2008 recession. We can see the 2020 recession as well, and rates dropped basically to 0. And you see the rate hike now up at is it 0.05 to 1%? Is that where
75 to 1?
75 to 1?
Yeah.
75 to 1. And we've also got in the dotted line the forecast of the number of rate hikes going forward. And I think this is a little bit older, but I think the number's sitting something like 2.9%.
3, yeah, basically 3%.
3% for the US 10-year rates.
Mm-hmm.
Interestingly, the Australian forecast rate is sitting also at 3%.
Yeah, and look, I think I mentioned this last week, that 3% by the end of this year is sort of
is that in Australia or US or both?
No, I think it's both. It might be slightly higher in the US, but I think it's 3% here in Australia.
Can you imagine rates being higher in Australia than they are in the US?
No, I can't. And I think we've said before that we think rates will peak out higher in the US than what they will here. And it's interesting. We were at a briefing yesterday with Richard Quinn from Bentham, and he was saying, what did he say? That he thinks rates will peak higher in the US. The recession here in Australia will be worse.
And I don't disagree with him. And
no,
so maybe just explain
also.
why he was...
So one of his key tenets there was that interest rates here in Australia, and we've talked about this a lot of time, that mortgage holders here in Australia tend to have variable rates, whereas in the US they tend to be fixed, and they tend to be fixed for a very long period of time. And there's no break clause. And so the only reason you would get out of your fixed mortgage over there is if you sold the house. Mm-hmm. And moved somewhere else. So
you can't refinance on a lower rate just because you want to?
Oh, you can. Yeah, absolutely. Sorry, the only reason you would do it now going forward, if you've already locked in your fixed rate, is what I meant to say. So if rates fall, you can refinance without any break fees, no cost, slight cost, but it's a couple $100, and you can lock in a much lower rate. And again, do it for 30 years. Whereas obviously here in Australia, you can't. There's quite an expense to that.
Well, there's break costs. And our mortgages aren't fixed for that long.
No, they're only, you can get 7 years, I think, but most people would do a 2 or a 3, I'm guessing. So that was one of the key, theories behind his thoughts there. And also that we've got, on average, I think, a higher income to debt, a debt to income ratio here in Australia as well.
And debt to GDP. Everything.
Yeah. Well, so,
but could it be
rates
possible?
Are going to hit a bit harder.
I agree, and I think further to that, but can't it be possible at all that, I don't know how this happens, and so the other side of the equation, so the debt to GDP or debt to income, could you not have the other side of that equation rise? And so the ratio starts to normalise.
So income.
Yeah, or GDP go higher. And so your debt, and that's sort of how you inflate your way out of debt, really.
Yeah.
I mean, that's possible.
It's possible.
Is it likely? Probably not.
Yeah. Yeah.
But the other thing Richard was talking about, you and I have talked about this on the pod weeks ago, was the US consumer and US corporates are cashed up, and they are in the best position they have ever been.
Yep.
For either it's from post World War II or ever, and either of those might be right. And so if we're going to have, or when we have that recession that everybody's talking about, the US is probably pretty well placed to weather that recession, and it's probably going to be the best they've ever been to fight a recession.
Yeah, and coming out of it, you would think they'll come out pretty strong, given all of that. Something that he mentioned that I haven't thought about for a while, but had kind of cast my gaze towards a few times, is as the US increases rates, that makes the US dollar way more attractive. And if the RBA, let's say the Fed is increasing at 50 basis points and the RBA is 25, that spread becomes larger and larger. The US dollar becomes more and more attractive. The Aussie dollar, relatively less so. Does the Aussie dollar lag to the point where the RBA has to start doing something else, whether they go out and start buying Aussie dollars, or do they start raising rates a little bit faster or more to make to support the Aussie dollar, essentially? Because if they don't, there's a chance we start importing inflation at a faster rate. So if you're buying US dollars and you're selling an Aussie, you've got, I don't know, petrol or whatever it is, you have to push that price up. So it can be inflationary having that Aussie dollar lag the US. So
yeah, but how much could it lag though? Really, like
I don't know. I mean, we're
not going to do a Zimbabwe where you've got interest rate to 80%, right? To try and entice investors.
So the Aussie's now it's at 68, 69. So, I mean, can we get down to 60? Is that out of the question? 60s historically, man, that's really low. And if the US are going to raise rates for a lot longer and they're going to peak out higher than Australia, I don't know, maybe the Aussie can stay low for longer.
Well, the question is whether the US, the Federal Reserve, actually has to push rates up that high. That's the unknown.
Yeah. Yep. Yeah.
Like, period. I think that's the unknown.
Yeah.
Because if 50 basis points is doing this to markets, and we had the inflation number coming in the US, right?
Yes.
So what was headline? Like 8.1?
8.3? It was around that number.
But basically, it was higher than expected, but it was lower than the previous print.
Yes.
And so we're seeing, as examples, we're seeing the price of timber or lumber fall dramatically. We're starting to see other areas that have been historically priced really high come down.
Used cars, new car prices are starting to come down.
The problem, though, is now you've got energy costs going up.
Yes.
Which is countering what we've been trying to fight the last 12 or 18 months. But you and I talked about this last week. We said it'd be really interesting to wait and see the year-on-year print number come down as we get to the high numbers, because we can't keep growing as much as we have been on an even higher year-on-year rate.
Yeah.
And so maybe the Fed doesn't have to go that far. I don't think the Reserve Bank is going to be pushed the cash rate to 3%.
No. Oh, God, I hope
and if
not.
they do, we'll hit that recession, and here we go. We can start cutting again.
Yeah, no, that's right. So it was 8.3. Expectation was 8.5. There was, I did hear that
expectation was 8.5.
Sorry, previous was 8.5.
Yeah, expectation was
8.1, I think.
Yeah, and it was 8.3.
We're right in the middle. There was a bit of a statistical anomaly in that they changed the way that they calculated. I think it was rents, and that added about 1% that they think. So, whatever, it'll all work itself out. But hopefully we're over that peak and we're starting to come down.
Let's talk about the stock market. And I've got a ton of charts I want to share now. Let's get this first one up. This is showing the Russell 2000 from January 2020, basically when we peaked, and to today. You can see the Russell 2000 is basically back to where it started pre-pandemic. So you can see on the far left-hand side of that chart, you've got the COVID bottom, and you've got a massive rally, and nothing really happened through 2021. And then you've got that slow drop from the back end of 2021, as most markets have been doing.
Yep.
And we've given up all those returns. The next chart I want to bring up now is there's 1, 2, 3, 4. There's 6 charts here which I got from Michael Batnick, and it's showing the price percent off their highs. Check out this list. Shopify down 81%, Zillow down 82%, Zoom down 85%, Coinbase down 85%, Robinhood down 88%, Peloton down almost 93%
far out
from their highs.
Yeah, that's mental. I mean, that's crazy.
The next chart is the US ETF, the QQQs, which is the NASDAQ. You can see it. In fact, it may have already hit the low, and if I think it's hit that new low, the largest drawdown going back to the GFC. So we saw it in 2020, but prior to that, this is going to be what we saw the last time we saw back into the GFC. Next chart is from Bespoke. This is the NASDAQ 30-day rate of change from 1971 to, I think, yesterday. You can count on 2 hands the number of 20% plus declines. And that line, that grey horizontal line is the 20% mark. And you can see there's a handful. During the 2000s, we saw that massive cluster during the tech wreck where we saw a whole bunch of periods of 20% declines. But we haven't seen this since the GFC, or COVID and GFC, and prior to that was during the tech wreck. But you can only count a number of hands.
How many fingers do you have on a hand?
10. How many people? 1, 2, 3, 4, 5,
There's
6, 7, 8. Except that cluster.
The cluster is 1.
The cluster is 1. You can count on your hands and toes.
But no, you're a cheery man today, aren't you?
And so the next one I want to bring up now, again from Bespoke, I'm just sort of collating all these charts and tables. It shows the NASDAQ 20-plus decline in 30 trading days from 1971 to 2022, but it then shows the subsequent performance after we hit the 30-day percentage decline. Have a look at the 1 month, 3 months, 6 months, 1 year. 1 year you're positive almost 73% of the time. The exception to all of this is the tech wreck. And it's
starting to smell a little tech wrecky.
It's very close to the tech wreck.
Yeah.
Let me keep going because I got a few here, and I'm just then get your thoughts. Next one, Nasdaq 25+% drawdown from highs. So we've gone from 20 to 25. You can see the average return again. 2000 was the exception there, and 1973. But have a look at 82. Have a look at 1998. You've got almost 91, 82% rises after we've seen Nasdaq drawdowns at these levels. Now the next one's the most interesting one for me. This is the same chart before, and what Bespoke have done here is do these big declines in the Nasdaq anticipate and precede recessions. Now you can see in this chart there's only 2. Yeah, so of the 11 prior periods where the Nasdaq experienced a 20+% decline within 6 weeks, all but 2 were associated with recessions. Now that's an 80% plus probability of a recession to follow.
Yeah. Wow.
The next chart I just want to bring up here is...
You've got more.
...is the S&P 500. I just LOL on this. Remember when index investors were going to get crushed? I just went through the likes of Shopify, Peloton, Zoom, etc. And we're down. And this is our tech wreck, I reckon. Like, these things, if this is not a tech wreck, like, I don't know what it's going to be.
I don't want to see one.
And all of those analogies that were being drawn to the early 2000s, late 90s, like, I reckon that's what we're going through. But we're just, but I feel like the formation of IT, the formation of how companies now operate is slightly different to that of the 2000s. And so maybe you're not going to see that at an index level. You and I have talked about the likes of the Googles, the Apples and the Microsofts being, 10 or 12 companies within the one company. I'm not sure we had it to that degree in the late 90s, early 2000s. But this is our tech wreck. And the S&P 500, and you can't see it here, but I'll say only down 17% from its high at the back end of 2021.
Yep.
So LOL to everybody who was predicting passive index investors were going to get crushed. Interestingly, and I'll bring this final chart up here, is from S&P FactSet. What this is showing in the blue line is the S&P 500. Now, just give me a second to explain this. The NTM is next 12 months. So next 12 months PE, next 12 months EPS. Have a look at the EPS number. EPS keeps rising. Look at the PE. It's falling. And so what we're seeing here is more sentiment driven. And you pointed this out before, about 75% of companies that are beating on revenue and on earnings.
Yep.
And this is another version of that chart, basically. And so most of this is sentiment. In fact, I was just having a look at the numbers. The S&P 500 forward PE has dipped below 18 for the first time since Q2 in 2020. So the peak of the COVID crisis, this is the first time we're dipping below an 18 times earnings. So a lot of this is what investors are willing to pay for stocks and sentiment over and above what is actually happening.
Yep. Yeah, there's a lot of, not since 2020. I think probably one of the things that kind of strikes me out of all of that is when we look at 20% falls and 25% falls and what's kind of happened last time, and they are fascinating. I think this time, and I don't recall what was happening with interest rates back in 2000. I think they were going up before. I think they were going right up until September 11, 2001. I think it was rates were rising all through that period. And I more and more, it's starting to look and smell a bit like this is going to last a bit longer. If rates continue,
rates were being cut. So
were they?
Yeah. So
into 2000 or post?
So late 90s. So in 1998, rates were about 5.5%. They bottomed during 1999.
Okay.
And during 99, they went from 4.5 to about 6.5%.
Okay, so 2%.
So yeah, so we 2%, but it's a 50% increase on rates. That was August 2000. Rates started to get cut, and we hit and there was a recession.
Yeah.
Subsequently.
Okay.
And then rates bottomed out at 1% back in 2004. And then we had the massive boom in debt in the US.
Yep.
And that's when we had that was the build up for the GFC.
Yeah.
But just going back to, just if I can finish off on that point, from a valuation perspective, if this is sentiment and not earnings, if we don't have a recession, let's just say this is one of those low probable outcomes that we don't have a recession. Stocks are friggin' cheap.
Yeah.
Right?
Yep.
But if we have that recession, you know what isn't baked in yet is earnings coming off. And so if we have that recession and the recession impacts earnings, I reckon there's a ton more to run here. And maybe Chris Joyce may be right. His 25 to 35% decline. Yeah, sure.
Possibly.
Anything's possible. And
absolutely.
I wouldn't discount the fact that we might, let's say we don't even have a recession. Nothing's guaranteed.
No.
It may not happen until, I don't know, we might have this soft landing the Fed keeps talking about. It has happened before.
Look, it has. I would take the
other side.
I'd take the other side of that.
But we've talked about this before. Recessions typically happen at the peak of the rate rise cycle,
which
rate
makes complete sense, right?
Yeah, I just
because once you hit recession, they're not going to keep raising rates; they're going to start dropping them. And at peak interest rate is when consumer spending has stopped, I guess, to the point where we're now in recession, and that. They're not trying to engineer a recession, they're trying to engineer a slowdown in spending. But unfortunately, that line is pretty fine. It's really difficult. As we said last week, they're handicapped to a point where they're using data that's old. So they're using data that's a month, 3 months, 6 months old. Not 6 months, but 3 months old. And they're trying to make decisions for what things will look like in the future.
Because no one can forecast anything.
It's incredibly difficult.
But it's no different to investors who say, I just want to wait this out and just wait for the recession. Like, the stock market will already have told you the recession's over.
Stock market's already moved.
Until you will only know that we've had a recession is after the print.
Yes.
And the stock market's run.
And the recession is 2 negative quarters, right? So that's 6 months.
6 months
and then
ago.
you get a month later. So it's 7 or 8 months before you find out we were in recession and the market's already moved.
Market's roared ahead, right?
Yeah, absolutely.
And so I think investors need to think about what game it is they're playing.
Yeah, and look, Buffett said it beautifully, at the meeting. They're not market timers. They may have gotten lucky a few times, but they just know when things look attractive and they keep investing and they're in there for the next, 50, 80, 100 years is what their time frame is. And so they just...
Well, you saw how much are they? 40 billion they invested in Q1 of 2022.
I think that was the largest on-market quarterly investment.
Yeah. And it's funny because Apple had a massive sell-off during that period as well, and it's when Berkshire were buying. And people are jokingly say, if you sold Apple, you sold to Warren Buffett during Q1.
Yeah. And look, the man knows what he's doing. So
look, he might be being laughed at now, but I think over the next couple of years, you're never going to pick the bottom, right? You might pick the bottom just by sheer luck. But if you can be buying at under 18 times forward earnings, I'm not saying this is the bottom, but maybe if you're drip feeding some money into the market, it's not a bad time.
And there are some pretty good companies out there making good money that are trading below 18. So there's some really interesting opportunities starting to appear. All right,
should we move on? Let's quickly touch on this. I'll get this chart up now. Online retail sales. I was writing a piece a couple of weeks ago. I don't know where I saw it, and I started crunching some numbers. I charted the US online retail sales as a percentage of total retail sales. That's the red line. And then you can see that green aqua line. The US, I should have drawn this, but basically if you chop that top off from 2020 to 2022, the US online retail sales is back to basically where it's higher. And I think this chart is not really doing it justice because of the UK numbers in there. It's dwarfing, the US is being dwarfed. But have a look at the online retail sales as a percentage of retail sales in the UK. And it's come off, right?
Yeah.
But let me bring this second chart up now. And this one's from Deutsche Bank. And I think Deutsche Bank saw my chart, so they've replicated one and distributed it.
Pretty sure that's what happened.
But they've got United States retail, electronic shopping and mail orders as a percentage of total sales. But then they've got Amazon's stock price. And what they're looking at here is saying Amazon's come off back to pre-pandemic levels. It's pretty clear we can see that. But what we're not seeing is on e-commerce sales falling as much as as Amazon fell. Mm-hmm. So is Amazon a proxy for online retail sales? Maybe it used to be, but maybe online retail sales are going to hold up a little bit better than that.
Yep.
And going forward, we're going to continue to see some growth in the percentage of online sales relative to retail sales. What do you think about that? Do you think we're going to give it all up, or will that trend continue?
No, I think that trend will continue. I mean, it's pretty well established. I think for me, the most interesting, and I've heard this number before, is that online sales only account for 15% of total retail sales in the US. I mean, that to me is a really low number, and probably speaks to the opportunity that Amazon and Shopify and all these companies probably are playing into. And with Amazon specifically, you know, they came out and said they've overspent on labor and capacity for, you know, for future distribution and all the rest of it. So, yeah, look, I think the trend continues. I don't think the online sales drops back to, say, a 10% of total sales in the US. It's probably a slow, steady accelerate or slow, steady growth. And when you think about who's more likely to buy online and who's less likely, older people less likely. Well, they're older. At some point, they're going to start dropping off the perch, and younger people, it's a more established way of shopping and so on and so forth. So I think it just grows over time. But interestingly, Deutsche Bank noted that Amazon's down now 35, almost 36%. And this is a few days old, so it's probably a bit more, maybe pushing out to 40% since March the 29th this year, which is 6 weeks ago.
What's this index they're looking at? The FANG, what's that FANG Plus index? Declining 38% since its new record high in November 2021. NY FANGs. What are the NY FANGs?
Oh, I don't know all the companies, but Netflix is one in there. I don't know what Y is. But yeah, so the NY FANGs index is down 38% since the record high in November, but it's still up.
I think they're just referring to the
like New York Stock Exchange. Oh, okay. Is there another FANG index? I don't know. Anyway, so the index is still at 30% from pre-pandemic, which annualized 15%. That's pretty good. You take that, right? Over 2 years? Given where we are now and what the outlook's looking like.
100%. 100%.
But yeah, I think retail sales continues to increase as a percent. And I think these companies, continue to grow. Amazon will be larger in 5 years' time in terms of market cap than what it is right now. I'll bet your house on it.
In 5 years in market cap?
Yep. Do you think that's wrong?
I wouldn't disagree. No.
I mean, they're just getting big. And this is ignoring AWS and all the rest of it. Anyway, I think it continues.
Just quickly, one thing that I saw, just adding on to that, was just this headline from Bloomberg, and I'll just get this headline up now. Disney tops streaming subscriber estimates but tempers outlook. Gains for Disney Plus follow the surprise decline for Netflix. Resorts prosper as travel tourism continue to recover. I had a look at the Disney share price. And, it's all good and well to have these narratives around stocks and these fantasy around, I like wearing Nike shoes, so I'm going to go buy Nike stock, or I go to Disney theme parks, so I'm going to go buy Disney stock. And we saw that just capitulate we've seen it over the last, when we talked about all this morning, that just whatever you think about the company, you could be dead wrong about the prospects in the future, because the market could just completely humble you and you could be totally crucified. And one of the examples is, and this is why I think stock picking is just super, super hard. For all of the reasons we've talked about, Disney appears to be, notwithstanding the fact that their resorts were shut down during 2020 and their streaming business went gangbusters, their stock price has basically done nothing since 2015.
Yeah.
Does that surprise you?
Yeah, absolutely. Really shocked by this.
Disney.
When you brought this up, I had to go and look at it myself because I didn't believe it. But yeah, it's flat for 5 years.
Meanwhile, the S&P 500's up, hundreds of percent. I don't know exactly what's up, but
we'll have a quick look. But no, it does surprise me because it's so diversified. The S&P 500's up 65% during that period.
Okay, not hundreds of percent.
No, but still pretty well. I mean,
it's annualized?
Comfortably off its high, like it was probably nudging 100% at one point.
Well, during that time, Walt Disney's down 5 or down 4%.
Yeah. No, look, and the reason it surprised me is, Disney, I'm sure you've been to a Disney theme park, and if you haven't, you go there and it's just this incredible experience. The customer
lunacy.
service focus is absurd.
It's insane.
Their movie business is massive. I mean, it's a lot of capital, but man, it makes a lot of money. Now you've got streaming and ESPN and just so many avenues for growth for this company. I don't know. And I had a look at their PE ratio, which was actually quite high. And I think that's historical, not forward-looking. But I was pretty surprised. And it's a company that I've always kind of admired as a pretty stable, I would imagine it's a stable, solid investment within your portfolio.
So just having a quick look at EPS Q2, they missed by 10%. Q1, they beat by 71%.
Man,
Q4,
nuts.
they missed by 23. Q3 2021, they beat by 45. So these massive beats and massive misses.
Yeah.
Like, just having a look at these numbers just look totally wonky. 6,500% increase year on year on net income. I think that's just
That doesn't seem right.
Closure to opening up, maybe.
Maybe.
But these numbers just look totally wonky.
Yeah, look at, I mean, everything's getting thrown out, right? As any slight disappointment's getting absolutely punished. So where was their high?
Yeah.
Their high was, I don't know, 100 and almost $200 a share.
What are they sitting now?
Well, I can tell me here. 187.
Yeah, almost $200 they've half.
So down almost half. Yeah, that's pretty surprising.
Well, it's interesting. Like last year and the year before, if you missed earnings, all you did was a share split and you're up 3 or 4%.
Yeah.
And now
doesn't matter what you do.
You miss earnings and you're
getting belted,
you get punched in the
10%.
face. Yeah, and
Absolutely.
kicked while you're on the ground.
Absolutely.
Do you want to talk about anything else on there, or do you want to should jump into director's
Let's
cuts?
jump into director's cuts. We've been going for a little while. All right, so director's cuts. So you may have heard a little bit about the crypto market in the past week or two. It's getting absolutely demolished. And there's a million different coins out there, and I'm certainly not going to go through all of them. But I read this article by James Garish from Market Matters. This was in Livewire, talking about some of the messages that cryptos are sending equity markets. So he was saying the volatility in crypto is a forerunner to volatility in equity markets, which I think we talked about earlier this year. But there were a couple of things that sort of jumped out and caught my attention. Now, I don't know a lot about crypto. By no means.
But apparently you're buying Bitcoin under 20,000.
But I'm happy to make predictions. Sure, why not? No one's going to hold me to it. No one will remember. So they're talking about Terra USD. So this is a stable coin. And for those who aren't aware, so stable coins are digital assets which are designed to retain their value. And I smile because they're not. But for example, the Terra USD...
It's the intention anyway.
It's the intention, yeah. The Terra USD's designed to peg to the US dollar, so dollar for dollar. So in theory, the price shouldn't deviate from $1 or shouldn't deviate all that much. So it guarantees that if you buy a coin, you can redeem it for $1 US. That's essentially the concept. So what's happened is that basically people bought this coin, consumer confidence, investors are all going in one direction, and that is not in favor of the coin. Everyone's starting to try and get out, and the Terra coin with a $1 peg is now trading, or was trading, at about 45 cents. So not so stable, not sure about the peg, but essentially for that to happen, I guess if you think under the hood, if someone wants to sell and it's trading at 97 cents, then someone's got to be willing to buy at $1, or the creators have to be able to stump up money to be able to support that at $1, right? So maybe they're running out of money. I don't know, but it's certainly not sitting there at $1. And that is by no means the worst. Avalanche, which is down 34%, Solana's down 30%. Luna, which I don't know anything about, someone was telling me earlier, it was at $100 odd. It's now trading at 4 cents. It's down basically 100%, yeah. 99.99%. So
it's been retitled Luna C.
Right. So some of these are getting absolutely demolished. I mean, we saw before Bitcoin's down 30 odd % this year. I still think there's more to come.
Bitcoin is the index of tech stocks. Meanwhile, while all these other shit coins are down 80, 90%, Bitcoin, you tell me what, Bitcoin's down 30.
So you're telling me it's done well?
Yeah, relatively speaking. That's a fact.
Well, isn't it a hedge against inflation?
No,
isn't it gold?
We debunked
gold,
this weeks ago.
It's a gold alternative.
We debunked this in January of 2022.
We did, and that wasn't difficult to do. Yeah, so the Nasdaq's down 27, and Bitcoin's down 39.
Yeah.
Up until this week, those numbers have been pretty close. So I guess my question to you is, are we seeing that capitulation? Are we seeing the investors that have jumped in over the last 2 years that all they've known is upside?
100%,
are they finally giving up?
100%.
Does it go further? Like at what point? So you asked me, would I buy? Would you buy? You've got Bitcoin. Would you buy more now? At any point, what would look? What's attractive?
If I was going to be buying, I'd buy some. I've got no money. I went too hard too early.
Yeah, man, absolutely.
But if people have been talking about wanting to get in crypto and now they're seeing this, go put your money where your mouth is.
Yeah, well,
see if you can stomach what is going on right now.
It's like what we talked about with Amazon all those years ago. And I was saying to someone earlier, like I recall, I don't know the year, but I think it was 2017 or 18, around Thanksgiving or Christmas, everyone was talking up crypto. It went on this big run and then it just plummeted. And we're in that sort of phase now. I still think it's got further to go, but I think, at some point...
Yeah, but so do tech stocks. So does Shopify. So does Netflix. They've 100%. There's more to go.
Yeah. There's a bit more to go. But yeah, anyway. So interesting.
Look, I think we've debunked this hedge concept. What does appear though is that Bitcoin does appear to be holding up relatively well, and I just emphasize the word relatively well. I don't know, like if you listen to the Berkshire Hathaway shareholders meeting, Warren Buffett talks about if you owned all of the farmland in America, and you came to me and you said you were willing to sell me 1% of that land, I will pay you whatever the cost is, $50 billion. I will pay you that amount of money. He said, if you owned all the rental properties and all the apartments and condos in America and you were selling me 1%, I will pay you 50 billion, whatever the number is. If everyone in this room owned all of Bitcoin and you came to sell me all of the Bitcoin, I would not pay you $25. And he says, what am I going to do with it? I cannot do anything with it. Uh-huh. And it's interesting now that, the euphoria has been, what's the word?
Oh, it's gone. It's gone.
It's been, that bubble's burst. And I think people can start thinking a bit more clear-headed. But I also think that investors typically will run towards euphoria and run away from pessimism.
Absolutely, man.
And so we're this pessimistic now, and people are like, oh, I'm glad I didn't do it, or see, I told you so. Mm-hmm. But I think there's somewhere in the middle ground between those, and I don't know what that is. If you listen to Charlie Munger, he says we already have digital currency. It's the dollar. It's your electronic banking. And so I don't know why we have to have these stable coins when clearly they're not stable.
Because there's no asset. They don't have the assets to back it.
That's right. No one wants UST.
No, exactly right. But it's interesting. I mean, Charlie and Warren have been doubters, we'll call them, of Bitcoin and been absolutely crucified for it.
But they were also being crucified for not getting on the meme stock mania.
Absolutely, and
this happened in the late 90s. I think you and I talked about this. I remember talking to someone about it on Masters in Investing, and we were talking about how we saw back in 1999, there were headlines in Time magazine saying Warren Buffett's washed up.
Yep.
He's lost his touch.
Doesn't understand tech. He's lost it. He's out of it. Yeah, right. Absolutely.
And then after that, you saw a massive run in value stocks, and Berkshire Hathaway stock went from in the doldrums to just front running all this.
And what's their largest on-market investment?
Apple.
Absolutely. It might be their largest single investment.
I think it is.
Yeah, Apple. Yep.
Speaking of Apple, the thing that I saw, which I'll just bring up now, again, Statista had the farewell iPod, the rise and fall of an icon. So iPod sales in units as a percentage of Apple's total revenue. I don't know who's buying iPods anymore.
No.
But the reason why I'm showing this chart is what's amazing to me is Apple's ability to constantly innovate. And I was watching a video of Steve Jobs. I think they had all their developers in a room, and they're asking what's happening with this project. And he said, "I've given that one a bullet in the head." And this is from, I don't know, maybe the late 90s, and you've got these developers saying, "What's happening with this piece of software or this or that?" He said, "I've been working on it." He said, "Oh, didn't you know that one's been shut down?" And you sort of laugh, and people are clapping and laughing and whatnot. But what I took out of that and seeing this is just Apple's ability to constantly innovate and not be afraid of exploring new products or new services or whatever that may be. You know, I remember having an MP3 player. They used to be so expensive, MP3 players. You know, having a Discman to MP3 players and just constantly moving with whatever the technology is. In fact, developing and creating the technology. And so, you know, I think that's one reason why companies like Apple, like Google, have demonstrated beyond what we saw during the tech wreck of the late 90s and early 2000s, that they have been sustainable for however many years. And I reckon they'll continue to do so. Are they going to continue to grow at the rates we've seen? History says no. History says once you become a top 10 S&P 500 company, you start lagging relative to the index.
Yeah. Yeah, and look, they keep reinventing themselves, and now, you know, it was the iPod, then it was the iPhone and iPads, and now it's the services side. We looked at it last week, services right, and the other gadget stuff. So, you know, they're growing a great revenue. What's interesting is they're still selling 14.4 million units. So back in 2004, they sold, I don't know, I'm going to say 2 million units. And that was about 15% of their total revenue. That's
interesting, actually. I didn't even look at that number. 14.4 million units
which
still being sold.
Which is 1% of the revenue. Yeah.
Is it? Yeah, okay.
Great. Just phenomenal business that continues to innovate and manage to make money.
What do you got for tips and recommendations?
Mate, I'm going back into the archives. Something my kids have been watching is a classic sitcom. Not classic, but around a little while ago. No, not that classic. So, Modern Family.
Oh,
do you remember Modern Family?
Hilarious.
Man, it's so funny. So they started at episode 1, season 1, and they've just been working their way through.
Really?
And man, it's
were they old enough to watch it when it first started?
No. And I think they're probably now old enough. Like, they get the concepts.
Right.
But some
Emma wouldn't be. The boys would be. Not Emma.
No. She'll sit there, but I think a lot of it goes over her head. But the boys definitely get it.
Swearing in Modern Family?
No, there's not. And so it's probably appropriate, and it's appropriate for the boys, but okay for her to watch. You know. But anyway, so they've been absolutely loving it. But I just love that you watch a show. You might watch Friends or Seinfeld or Kramer or whatever it is, and you look at that then and go, would that get on air today?
Oh,
like some of the jokes, you know. So I can't remember the dude's name. The guy that, you know, the father of
Phil Dunphy.
No. Phil. I love Phil. He's my favourite character. His father-in-law, Jay Pritchard.
Oh yeah.
You know, some of his comments, you know, about his son being gay and about the Colombians and about this and that. It's just, it wouldn't fly today, but man, it's so funny. It's so well done. So anyway, that's my recommendation. Go back and watch an old show. You know, it's so good.
Man,
there's some great ones out there.
Talking about inappropriate comedy, did you ever watch Eddie Murphy Raw or Delirious?
Oh, God, yeah.
Can you?
Holy shit. Not a chance.
Can you imagine any of that getting airtime right now? No way.
No
way.
Would Netflix touch it?
Possibly. Netflix is there on the fringe with stuff like that, with controversy.
Yep.
But man, gold.
Some of that stuff's awesome. What do you got?
As we left the briefing yesterday, we're at Baharian on Little Collins Street, top end of the city. Man, I haven't been, and if anyone hasn't been to Baharian recently, Like, I haven't been there for years, and as you know, I'm vegan, and we had lunch somewhere else before that, and weren't as impressed. But at Baharian, man, that was bloody. I don't know what you thought.
It was good,
but the food there was bloody good. And as I was leaving downstairs, I don't know who it was, some guy who looked very official, an older gentleman downstairs. I just said, mate, food bloody fantastic, and I said, that's what we do. He was rapt to get the feedback. So any vegetarians or pescatarians or vegans, go check out Baharian. Like, the food was bloody good.
Gluten-free. It was good. Yeah, I was impressed.
You had some of the potatoes?
I did.
Potatoes it's not gluten.
No, man.
You're good.
It's potato.
It's like people asking me, stupid, can you eat this as a vegan question? All right, let's wrap up. We've hit on the 60 minutes, I think. Info at baharianwealth.com.au, and we'll catch you next week.
Cheers, guys.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.